1929, the specs, the really crazy stocks, went down all year. Little known fact, but they did. The day before the crash, they were down 30% as an index. Nothing like that happened again until 1972. 1972, in the Nifty 50, the S&P went up 17 and the average big board stock went down 17, so that I could remember it forever. Symmetry. Nothing like that happened again until 2000. And then in 2000, in the tech bubble, the dot-coms peeled off in March and really collapsed. And then through the summer, the junior growth, the medium growth, and then finally the senior growth all peeled off. And by the early fall, most of them were down 50%. And some of the dot-coms were down a lot more. But the S&P was unchanged, which meant that the 70% that was not growth had gone up 18%. So the S&P blue chips had gone up 18, and the growth and the NASDAQ and the dot-coms had taken a very big hit. That is absolutely classic. Now, starting early last year, one by one, the various most speculative groups that had done brilliantly in 2020 started to do badly. These great bubbles have nothing to do, very, very little to do with the underlying reality. That started in 2020, December. And then the meme stock started March, April, and Bitcoin, April, May, June, and so on. And then one by one, most of the advanced techie stocks started to come down. And ARK peaked out a couple of months later and has, of course, declined 75%. ARK is a whole portfolio of 25 growth stocks that often have no earnings, but do have, at least in the portfolio manager's belief, huge prospects. But that kind of stock is very vulnerable to a loss of confidence. And therefore, it started the decline pretty early and continues today right into the teeth of the sell-off. So this market has been proceeding eerily like 2000. And I think phase one, superficially, you have a 2000 tech bubble. Horribly overpriced, much too much enthusiasm, huge buy-in by individuals, fueled by a massive program of cash distribution associated with COVID bailout. A lot of that found its way into the stock market. So this was sensational. So that's phase one. Phase two, which I really worry about, is this whole thing morphing into what I call the 1970s. Underlying inflation as an everyday topic once again. It may not be spiking. In the 70s, it came and went. It was always part of the background discussion. And that's what I think it will be now for quite a long time, several years. And similarly, interest rates were always a worry in the 1970s, and they will be a worry for quite a few years to come. Beyond that, longer term, I worry that we are fairly deep into running out of the cheapest, most available resources. I think that turning point was 2002. Between 1900 and 2002, the average important commodity came down 70% in real price, adjusted for inflation. And we keep our own index at GMO, 36 most important equal-weighted commodities. This is not dominated by oil. This is looking at the breadth of what is happening to commodities. And then if you look at that again today, it is not down 70%. It's down 10% since 1900, a rounding error. So it's gone from down 70 or 30 on an index basis to 90. It has tripled since 2002. The average important commodity has tripled in real terms since 2002. And I think this is an important problem going forward. We haven't done any capex. There are no great reserves of copper, lithium, cobalt, nickel, etc., waiting to crush onto the market. And yet we need them to green the economy. We're simply going to run light of these metals. We need technology to design a way around them, new batteries that don't use so much, recycling techniques to save what we have, etc., etc. We have bad actors around the world, as we see in the Ukraine with Russia. An unstable situation such as this that we are likely to see with food does not bode well. The other thing we have to bear in mind is that the developed world and China are beginning to run out of people. In any developed country except Israel, we're not replacing our people, and nor is China. We're all collectively having a fertility rate as we sit of about 1.6, and we need 2.1 to replace. So each cohort of babies is running now about a quarter below replacement. So if you're running out of labor, and we have been for quite a few years, so we know that the cohorts of 20-year-olds starting now will be declining, guaranteed, over the next 20 years. So you have a shortage of labor, which feels inflationary. You have a shortage of cheap, plentiful resources, metals, food, which feels inflationary. And you have a very tricky, complicated situation on which we could spend an hour on energy as we try and transition from fossil fuels to green. And we will be lucky if that is not inflationary. It may not be, but it may be. So all in all, we face some very intractable inflationary problems that we have not faced. It's one thing squeezing your labor for the odd 5 or 10 years. We've been squeezing our labor since 75. That's 25, 35, 47 years. And a lot of that is not profitable in any way. They are losing the ability to be healthy, viable members of the economic society, some of them. And if you look at the growth rate of the US economy, yes, it's had a very flashy top 10%. The FANGs are brilliant enterprises, probably a better handful of companies than we ever had at any time before in terms of their unique ability to move fast and make new ideas. But if you look down, further down the system, you find the level of new enterprises undertaken in the US is way down. The number of people in companies 1 or 2 years old is half of what it was in the 1970s as a per capita basis. We're simply not as broadly adventurous and capitalistic as we used to be. Why not? Well, for one thing, there are no capital reserves. You can't even raise enough money to start a barbershop. You ask, how much money do you have in reserve? And a third of Americans can't put together $500. You know, this is not a healthy system that we've developed. And the growth rate of the US economy has slowed more than people realize. That the productivity component has slowed down from 1.8 to about 0.9 for the last 15 years. 0.9. Now, it's still semi-dignified, but 1.8 compounds a whole lot better. And the problem there is you add to productivity, you add the increase in the workforce. And back in the 60s, you were adding 1.5% a year to the workforce. In the next 20 years, we'll be lucky if we only subtract 0.2%. So we've had an enormous drop of 1.7% a year in labor, and maybe more. And we've had a pretty steady drop of 0.9% in productivity. This is indicative that all is not healthy. And I think the central poison to the system is a blinding increase in inequality.